Hey everybody, welcome to this week's video. As always, we'll be covering the datasets, the earnings, and the SPY technical analysis for the week of August 24th, 2026. And with that said, let's go ahead and get started. Alright everybody, as always, getting started with the data. For Monday, we don't have anything significant, so we're not going to be focusing on that at all. For Tuesday, we have the weekly ADP employment change. Nothing significant there. Those numbers have been very low. We're all kind of aware of that. We do have some of the housing data, not really focused on that right now. When the time comes, if we're starting to have issues with mortgages and, housing crises and whatnot, we will start focusing on that data, but currently it's nothing really in the scope of what we need to worry about. We do have the CB consumer confidence, which is very important. That's going to be at 10 a.m., so 30 minutes after the open. Now, it has pulled back up from where it has been over the beginning of the year, okay, and basically over the entirety of 2025, is that it was pulling down to that low 80s range. It has popped back up to the 90. Now, that's not a good thing exactly. We're still not out of the woods just yet, and I know consumer data overall has been trending downward, so I do expect the CB consumer confidence to trend downward, which should be good for the yields, should be good for the dollar, potentially good for equities. So definitely pay attention to that one. Now on Wednesday, we have basically the big data this week. We have the PCE data, we have the GDP data, we have the personal spending data, basically a ton of super important personal consumption expenditures data going out. So 8:30 a.m. definitely be watching for those. Those can make a major impact on the market. We've seen some of these quarter over quarter GDP prints alone absolutely rally the market. We've seen some of these absolutely dump the market. So kind of on a fence right now. I'm not going to speculate too much on these numbers. Some of these were in the negatives last time. Some of these they're expecting to trend down. Some of these they're expecting to pull upward. So, and by them I mean the forecasters. So, I'm not going to speculate on these numbers just yet. I do know that the PC data is going to be following the CPI and the PPI just a little bit. So, seeing how the CPI and PPI have just been absolutely in shambles the last couple months, we should be expecting the core PC to start trending down as well. For Thursday, really nothing significant other than the Jackson Hole Symposium is starting. That's basically what's, replacing the FOMC meeting this month. Happens every single year. Nothing really significant comes out of it too much. I haven't really seen anything from the Jackson Hole Symposium ever really shift the markets. However, on Friday, we actually do have a speech from Fed Chair Warsh, which is kind of surprising during this Jackson Hole Symposium. Usually they're pretty quiet during this time, the Fed anyway. So it's going to be interesting hearing his speech. And we also do have some important data sets. We have the Michigan inflation data, the consumer data, the expectations, but the main data set that I'm looking forward to on Friday is this payroll benchmarks. I think that's very important and, something to watch out for. But overall, Wednesday's the big day this week. Potentially Friday could give us uh, a little bit of differences within the data because we do again have uh, Fed Chair Warsh speaking. He can definitely shake up the market quite a bit, but I'm not really anticipating a whole lot out of Friday. It's mainly that Wednesday time slot. Now for the earnings this week. That's actually going to be very significant. As you can see, our big boy Nvidia is on Wednesday at close, so that's obviously going to have a massive weight on the market, whether they, do good or not, whether they just meet expectations, doesn't really matter. Whatever they do, it's going to definitely influence the market. So pay attention to what happens with Nvidia in the after hours. However, we do have a couple other important earnings as well. We have crowd control, which is very crucial. We have Salesforce, which Salesforce isn't going to exactly move the market too much, but it's very important to read the the guidance and everything because it's one of those front-facing consumer companies. So if you want to know what the consumer is doing, you kind of read the Salesforce earnings. We also have HPQ, which I'm not too interested on, but I do know that HP and Intel kind of go hand in hand right now, so it's kind of important to pay attention to what's going on with that, but not as important as some of these other earnings, obviously. Now, for Thursday, we have Marvel, which that's been heavily endorsed by Nvidia. They're putting quite a lot of money into it. They do believe that that's going to be one of the next, 1 trillion market cap companies. So it's definitely important to, pay attention to what's going on with Marvel because they absolutely have the ability to have a very good earnings and rally the market quite a bit. But in terms of the overall earnings this week, what I'm really paying attention to is Nvidia and Marvel. Both of those can, absolutely rally the market. They can absolutely dump the market. So definitely pay attention to both of those. Trading is a skill that can last for a lifetime. Join my Patreon for live classes, my personal market analysis, premium Discord access, and direct communication with me. Invest in yourself, become a more consistent trader, and build a better future for yourself and your family. Visit patreon.com/wooksy to join today. Thank you so much, and let's return back to the video. Alright everybody, and let's jump into the technical analysis. Now before we get started, I just kind of have a question for everybody. If you'd like me to go over more than just SPY, so if you'd like me to go over potentially like the treasury market, gold, things like that, just let me know. And secondly, I know that someone made a comment about these not being fully technicals that I'm going over. I highly disagree with that. I may not be going over wave theory or some other stuff, but this is absolutely technicals and they hold very true to it. So with that said, let's go ahead and jump right into the moving averages and Bollinger Bands. Now, last week on on Thursday, we got very, very close to pushing into the 20-day moving average. The 20-day moving average 20 MA is currently at the 762.33. We did push down to, what was it, that 762.04 on Thursday. So the 20 MA was actually underneath that level. On Friday, it pulled upward, and we traded around that 764 to the 767. Okay, now with that said, we did not push back up to the 5-day moving average, the 5 MA, which is currently at the 767.50. That will be pulling downward very, very lightly, depending on where we open on Monday. So I am expecting that to be around the 766, maybe even the 767, but not at the 0.50. It might be almost exactly at that 767, which means that we're getting very close to having another 5-day moving average test. Okay, and this is something I've been talking about when we started pushing down, is that I said usually before we retest that 20-day moving average, we're going to pull back up and retest the 5-day. Okay, that's very, very close to where we're at right now, and I still think that's going to hold true. Now, with that said, if we continue trending back upward, we will see the 5-day moving average crossing back over the 10-day moving average, and essentially we will be heading back up to the upper Bollinger. That's kind of the major bull thesis at this point, is having a bounce off the 20 MA. However, again, we did not fully test that 20 MA. So there is still room to test that. And I do believe that's going to happen after we retest the 5-day moving average. We should basically go from the 5-day and head back down to the 20 MA. Now, with that said, our volume profile, and again, I still am a little perturbed about that comment someone made, but without just checking the Webull, we check some of our in-house tools as well. But on Webull here, we are seeing that the daily volume has dropped on the buying significantly. And with that, we're starting to see the selling volume picking up. We're also seeing the ADL heavily pull down. Okay, since the all-time high, the ADL has pulled down significantly. Okay, almost back to the point of when we were back at the 730 range. So a very, very large drop in the ADL. And if we continue to see that trending downward, that's going to continue signaling to us that money is being withdrawn from the market. Okay. Now with that said, let's go ahead and move to the hourly time frame, and we're going to pull up our drawings here. I know there's a lot going on the screen, but they are very important. So now we did break away from this consolidation channel, and that's very, very important. Now with that said, this can still form part of that consolidation channel. We can see this expand to the downside. So if we start, and let me go ahead and get my drawing tool out just one second. But seeing how there's support here, and if we start building support in this range, this can create the consolidation channel moving downward and us ranging in between that area. Okay. However, and as you can see as we're zooming in to this top of this selling channel, is that the top of the selling channel is being heavily, heavily, heavily respected currently. Okay, and what that's telling me so far is that if we're going to continue following the trend of that channel, that the next move is to move down. Okay, and that makes a lot of sense. That makes a lot of sense to start moving down from here because all we have is supports to break at this point. Now, we've been kind of talking about this in last week, is that there actually isn't a lot of room in these supports. And what I mean by that is that it's not like when we were down at this 730 to 719-ish range where we have multiple different supports to work on. We have massive ranges between these supports. So between the bottom of this 761.99, that being a newly created support, the next support from here, besides the 20-day moving average, is the 758.11. From that, if we continue selling downward, we're going to sell down all the way to the 748.80. Now, going back to the daily time frame and back to our moving averages, there's a very crucial level between that. There is the 50-day moving average. Okay, now I don't really look at the 50-day moving average in terms of a level to test, but more so as a kind of like a longer term indicator. So I don't expect the market to kind of like hit that level and bounce or, pull under that level and then start heading up. You more see these trends where either we're going to be pulling underneath the level and then working above it, or we're going to be trending above that level. Okay, so we're kind of in that dangerous territory right now where if our moving averages and if the price keeps heading downward, we're going to see the 5 mile pulling underneath the 20 mile, which is going to start pulling the 10 mile underneath the 20 mile, and then we'll be in a short-term bearish posture. Okay, that's, the posture you're looking for bearish price action is having your 5-day under the 10-day under the 20-day. From that, we would then be looking towards the 5-day moving down, pushing underneath that 50-day. Okay, which if we hold that with conviction, we'd start seeing the 10-day pulling underneath that level, the 20-day pulling underneath that level, and then at that point, we'd start being able to target a lot of these supports that we have. Now within our channel here, we absolutely have the ability to start heading downward if this channel holds persistent. Okay, now if this channel does not hold persistent, like we talked about, then we can expect some of that ranging. Okay, and if we do have some of that ranging going on, what's going to happen is the 50-day moving average is going to pull upward. The 20-day moving average will pull upward slightly, but you're going to start seeing a lot of consolidation within those moving averages. Now, again, I don't think that's going to be the case. I could be incorrect, but so far our volume is showing that the buyers have kind of tapered out. Sellers have really stepped out or stepped up. The ADL is showing the buyers have really, kind of dropped off, and we're seeing a lot of selling going on. Okay, so unless we see something that's really going to shift the narrative, I don't think that this is going to ease up anytime soon. In terms of mean reversions and pulling up our Bollingers, is that we did pull from that upper Bollinger, getting ready to pull down to the middle band, which is also the same as the 20 mile. And from that, we can start heading down towards the lower Bollinger. Okay, now one thing to really kind of reiterate here is that This is the first upper Bollinger move since October 28th of 2025. Okay, and that's very important to pay attention to, is that we have had multiple lower Bollinger moves throughout the year. We've been trading, very much so within the lower Bollinger for a large portion of this year. But we haven't been trading within the upper Bollinger for a large portion of this year. So seeing a bounce back up to the upside and pushing the upper Bollinger again isn't out of the question. Okay. However, we have been seeing the yields picking back up, but we have been seeing the dollar drop. Okay, and the dollar dropping is very important for equities overall. It does mean that there's going to be more cash to push into equities. However, we have been seeing Bitcoin pulling upward. We've been seeing gold pulling upward. We've been seeing silver pulling upward. So are we seeing the liquidation of equities to be pushed into other markets? The potential for that is very high. Okay. It's still a little too soon to, make that determination. Now, something to pay attention to here, which again, kind of swapping from our charts back to the CME, is that the CME odds have still been kind of favoring the pause or the hold within the rates for September. There has been a little shakiness, which might be hard to see, might be a little difficult to see on the screen, but we did go from last week, basically, or a week and a half ago, being at the 33% chance of a hike, currently at a 40% chance. Now, I think a lot of this is getting priced in mainly due to the 30-year yield pulling upward, okay? But I don't think that this is really within reason currently. However, going into October, we do see that the odds of a pause versus a rate hike has essentially shifted back to 45%, 45%. Okay, with the odds of two rate hikes, which that's that's pretty much not going to happen at this point, but that's still at a almost 10%. Okay, whereas 2 weeks ago, week and a half ago, we were at a 53% for the pause, a 40% for the hike, or for the singular hike, and then a 6.6% chance for the two hikes. Now, again, starting at the end of July, these odds have shifted immensely. Okay, it was a 12% chance of being a pause for this October meeting, with 45% chance of having the two hikes and 35% chance of having, or excuse me, the 45% chance of having a single hike, 35% chance of having two hikes, and then 7% chance of having three hikes. Okay. Um, Very crazy for people to think that's going to happen. Um, but with that said, the odds of the rate hike right now has shifted to the upside slightly. We also see this within December. We see that within December, as of a week and a half ago, 2 weeks ago, we had the odds being a 32% chance of a pause, a 45% chance of a hike, almost 20% chance of two hikes, and a 2.6% chance of three hikes. Okay. Now that's shifted kind of in the favor of additional hikes again. It's dropped down to 27% chance of the pause, 45% chance of the single hike, the 24% chance of two hikes, and now almost 4% chance of three hikes. Okay. Very, very unlikely we're going to be getting three hikes. Very unlikely I even think we're going to get this single hike. Okay. The economic conditions right now and the macro has been heavily favoring the Fed just sitting in and pausing rates. Now, I think that, again, the 20-year treasuries moving upward, or the 20-year treasury percentage moving upward so much has really kind of, scared a lot of people. And because of that, the CME kind of has to price in that odds of the higher rates causing a rate hike. But again, that's not what causes rate hikes. Okay, it's the economic conditions underneath what's going on that caused the rate hikes. And we do know that the CPI has been dropping into the floor, the PPI has been dropping into the floor. Very likely we're going to see this PC report give us a pretty weak reading. We've been seeing the labor market dropping immensely. We've been seeing consumers dropping immensely. And so the Fed can't hike rates into that. Okay. We also see our dollar telling us a story that, a lot of people just aren't paying attention to. When the dollar pulls down, that does not mean you hike into it. Okay. This usually means that the rates are going to be easing. Okay. So even though we might be seeing a very short run increase in these yields, doesn't mean that that's going to last for very long. Okay. Um, if the market really believed that these yields were going to be holding, then you wouldn't be seeing gold being bought like it's currently being bought. You would not be seeing the dollar dropping. You would not be seeing, some of the conditions that are happening occurring. Now, again, what I do think is occurring is that very likely the Bank of Japan situation is kind of really hitting our bond markets. And what that means is that the Bank of Japan is really in a between a rock and a hard place, where if they don't get some major US backing and intervention, then they're going to have to sell US Treasuries. Well, what happens when they decide to unload a bunch of US Treasuries? That's going to spike the yields up short term because those treasury buyers are going to want higher yields on those notes. Okay, or they're going to be wanting to buy those bonds for a lot cheaper. So that is something that can drive the yields up in a short run. But we're not seeing QE. I know a lot of people are calling it QE, but that's not what we're seeing. We're not seeing money printing. And so it's creating tighter conditions within the treasury market. And within those tighter conditions of the treasury market, a lot of people, I believe, are making the mistake to also price in the fact that, oh, well, higher yields, we're going to get rate hikes. I heavily disagree with that. I think a lot of our other data sets and um, instruments and indicators are telling us otherwise. A lot of these instruments and indicators and data sets are telling us that we need lower yields and lower rates. So kind of a toss up between the two, and I think it's going to be kind of interesting seeing the next few months as that progresses. But I do think that the Bank of Japan is putting a ton of pressure into this situation because they don't want to be dumping their long-term treasury bills, but they're kind of in a point where if they don't get help almost ASAP, they're going to have to. And because of that, the bond buyers, the bond market will react to that. They will demand a higher yield. Now, that doesn't mean that we're going to be giving them a higher yield. We're having our treasury sales doing absolutely fine at the current yields. And that means that just because we see the US 10-year move up, the US 20-year move up, it doesn't mean the Fed has to follow up and sell higher yielding bonds. Okay, so I think that's a mistake a lot of people are making right now. So, with that said, my expectation for this week really is that we're going to test the 20 ma, or firstly test the 5 ma again. Very likely see a rejection down to that 20 ma. Start seeing the 10 ma pulling underneath that 20 ma. Start seeing the 5 ma pulling underneath that 20 ma, and basically start seeing a continuation of the selling. Especially as people are starting to price in the potential of those rate hikes. But overall, should be a fun week. We'll talk about the price action after tomorrow's session and see if this selling channel holds strong. If this selling channel holds strong, then we kind of know our expectations. If it breaks and we enter back into that consolidation channel, then potentially we have to reevaluate what's going on with the selling channel. Now, again, one thing with the selling channel is that we are focusing a lot on the top right now. However, we can focus on purely supports, okay? And based off of supports, we can have a higher slanted channel, okay? With that higher slanted channel, this would still be within a selling channel. And we still see that very much so. So while I might have this first channel set up in a different way, doesn't mean it's going to hold that way. The reason why I have it set up so steep is because I'm basing it off of prior supports. Okay, and because we're basing it off of those prior supports, that's telling us that, that's what we have to work on. But we do have some support built here. Okay, and that means that we can base the selling channel off of this support as well. So definitely keep an open mind this week. But remember, we don't have a lot of data until Wednesday and a little bit on Friday. So we might see the next two sessions being very slow. And I think that's very reasonable, especially with NVIDIA's earnings coming up on Wednesday afternoon. I don't think that people are going to be heavily buying into the market prior to the earnings or even trying to heavily sell off prior to the earnings. I think that we're going to see a lot of just sideways trading or slow trending downward. Okay, so with that said, that's going to be this week's video. Thank you so much for watching. As always, I would love to hear some comments if you'd want me to go over different markets and different symbols and everything in these weekly videos. I'll be happy to do so. But yeah, with that said, thank you all so much for watching. Thanks for the comments. Thanks for the support. And I will talk to you in tomorrow's video. Take care, everybody.